Okay, let's unpack this. We are staring at financial headlines that, they feel like they were ripped straight from the depths of 2008.
They really do.
But the names on the ticker aren't the old banks. They're the giants of the future. Specifically, Oracle. The credit fear gauge on them, basically the cost to insure Oracle's massive debt against a default, has spiked. We're talking levels not seen since March 2009.
It's a huge alarm bell ringing right in the heart of this AI boom, and the signal it's sending is it's highly nuanced.
Right.
We're diving into credit default swaps, or CDS, as a critical early warning system, and we're focusing on this just staggering debt pile Oracle is racking up to fund its AI infrastructure.
And the reasons for the spike? It's not straightforward.
Not at all. It's this complex collision of, aggressive corporate financing, some real fundamental risk that feels a bit like a bubble, and then some very sophisticated financial engineering that's using Oracle as a proxy for risk.
That distinction right there, fundamental risk versus what you're calling technical risk, that's what makes this deep dive so essential.
Exactly.
This isn't just about whether Oracle itself defaults. It's about how Wall Street manages, or maybe mismanages, the explosive growth of all this high-stakes, illiquid private debt that's tied to the AI build-out.
And we have a stack of sources here detailing the quantitative metrics, the history of CDS, the actual mechanics of how risk is being transferred between banks and hedge funds.
Right. So we're going to give you the shortcut to understanding the entire ecosystem.
We'll dissect the financial engineering of these credit default swaps. We'll translate dense terms like basis points into, real dollar costs.
Okay.
Then we'll pivot to the really crucial, less reported part of the story, this technical tsunami. Why banks are using Oracle CDS to hedge risk that isn't even Oracle's risk to begin with.
Our mission here is to equip you with the knowledge to look past the scary headlines.
Yeah.
I really understand the crucial mechanics of why this is happening, what it means for the whole AI financing model, and what you need to watch next.
Look, do it.
So let's jump straight into the data that sent these tremors through the market.
Yeah.
The shocking data point, it really has to be put into historical context. We're talking about the 5-year credit default swap on Oracle's debt.
A blue chip company, a foundational tech name.
Exactly. And yet the cost of insuring its debt just hit levels not seen since March 2009.
And you have to think about what March 2009 really represented. That was the moment of just peak uncertainty.
Total panic.
Total panic. Lehman Brothers was already gone. The global banking system was seizing up, and, nobody knew who held all the toxic assets.
Right.
So to see a high-grade corporate name like Oracle trading at that same level of credit fear almost 2 decades later, in the middle of a huge tech boom, that demands some serious scrutiny.
So what exactly did the price hit? Let's get into the numbers.
The price for this 5-year protection, it surged to 1.28 percentage points a year, or, as traders would say, 128 basis points.
A tripling. A tripling of the cost of insurance in just a few months.
That's the scale of the move.
Because back in June, it was sitting comfortably at something like 0.36 percentage points?
As low as that, yeah, 36 basis points.
Yeah.
And a move of that magnitude, it's usually reserved for a company that's experiencing some kind of unexpected catastrophe, not one that's supposed to be leading a global technological transformation.
And this has definitely caught the eye of the big banks.
Oh, absolutely. The upward momentum has the major strategists talking. While the gauge might have tightened a little bit the next day, the overall movement, it signals a massive recalibration of risk.
I saw Morgan Stanley put out a note.
They did. Morgan Stanley sounded an explicit warning. They cautioned that Oracle's rapidly accumulating debt risks could drive the company's CDS even closer to the 2 percentage point level.
2%, so 200 basis points.
200 basis points.
That would push it above its 2008 all-time high.
It would?
That's not just market noise. That's the fixed income world shouting about a structural risk.
Yeah. Why Oracle? If the AI build-out is such a strong narrative, why are they the one flashing red?
I think we have to contextualize Oracle's debt strategy versus its peers. Structurally, Oracle is the lowest rated of the leading hyperscalers.
Right, the big cloud providers, Microsoft, Amazon, Alphabet.
Exactly. Those 3 giants have unparalleled scale, and they're swimming in cash flow from their established cloud operations. They use that cash to fund their AI expansion.
But Oracle's approach is different.
It's radically different. It's aggressively debt-fueled.
And we can quantify that aggression, right? This isn't just talk.
The numbers are staggering. We know Oracle recently sold $18 billion of U.S. high-grade corporate bonds. That was back in September.
That's a big public deal.
A very large public transaction. But the sources are highlighting something even more significant. They're reportedly in the process of syndicating a whopping $38 billion of private credit.
Whoa, okay, let's just pause on that number. $38 billion. It's huge.
That is an enormous transaction, especially in the private credit market, which, for context, is less regulated. It's less transparent.
And that scale of borrowing, that specific transaction, it sets the stage for the entire technical hedging problem that we're going to get into later.
Right.
And this massive capital injection, it's all tied to the AI build-out. Oracle's data centers are foundational to its partnership with OpenAI.
The one that's projected to generate hundreds of billions of dollars in revenue.
That's the promise. But the market today is focused on the immediate cost.
So what does this borrowing spree mean for their balance sheet long term?
The long-term picture is where the credit market gets truly nervous. Oracle is aggressively borrowing for infrastructure today, betting on those future OpenAI revenues.
I see.
Projections show that its net debt is expected to triple to $290 billion by 2028.
Triple. Wow.
This strategy just puts Oracle in a fundamentally different risk category than its peers. Microsoft or Alphabet, they're internally financing their expansions. They maintain minimal leverage.
Right. They're using cash they already have.
Exactly. Oracle is taking on massive leverage based on a future and still largely unproven revenue stream. And that difference in financing is the core fundamental stress the CDS market is screaming about.
So an established cash cow funding its growth versus leveraging up for a speculative, though potentially enormous, future opportunity.
You've got it.
That explains the fundamental worry. But to really understand the spike, we need to understand the tool itself.
Yes, the CDS contract.
So before we move on, let's just talk about the credit default swap. It's a term that is, loaded with baggage. It instantly brings to mind financial collapse.
It really does.
But we need to strip away that sensationalism and just understand the engineering. At its core, it's just insurance on a debt, right?
It's the simplest and most effective way to transfer credit risk. A CDS is just a contract that protects an investor, a bondholder, a lender against a specific credit event. Usually that means the company, Oracle in this case, fails to pay its debt.
And the mechanism is pretty simple to visualize.
Very simple. The buyer pays a periodic fee, like an insurance premium, to the seller.
Right.
And if that credit event happens, say a bankruptcy or a failure to pay interest, the contract is triggered. The seller of the protection then has to compensate the buyer for the losses.
I see. So when that yearly fee, the spread jumps from 36 basis points to 128, it's a direct signal from the market that insuring that debt just got a whole lot riskier.
And more expensive. It's the definition of a leading indicator of credit stress.
And we have to address the fear, the GFC connection.
Yes, it's crucial. CDSs were not the cause of the 2008 crisis, but they were the amplifier.
Okay.
Originally, they were actually designed as a responsible risk management tool for banks. If a bank lent money to, say, a major car manufacturer, they could buy a CDS to protect themselves if that company went bankrupt. A simple hedge.
But the trading volume just exploded far beyond that simple hedging.
It did. The market became dominated by speculation. You could sell protection on debt you didn't own, that's what they called a naked CDS, or buy protection on debt you didn't hold.
And that's what created the systemic risk.
It created massive systemic risk because, first, there was no limit to how much protection could be sold on a single company. And second, the biggest sellers, like AIG, they didn't have the collateral to actually cover their obligations when defaults started happening.
A massive, uninsured casino.
That's a good way to put it.
That's why this current Oracle situation, even though it's referencing 2009 price levels, it needs a much deeper look. It might be less about systemic collapse and more about a structural change in how debt is being financed.
I think that's right.
So let's quantify the current stress. The price is 128 basis points. How does that translate into a real cost for an investor?
Okay, let's make that spread practical. So 1 basis point is 1/100 of 1%. So 128 basis points is 1.28%.
Right.
So for a large institutional investor looking to protect, say, a $10 million position in Oracle debt, that annual cost is roughly $119,000.
Which, it sounds like a lot, but in the grand scheme of credit risk, it's still relatively cheap.
Exactly. I mean, to put 128 basis points into context, if Oracle were a high-yield or junk-rated company, a riskier energy firm or something, the cost to insure its debt might be 400, 500, maybe even 1,000 basis points.
Wow.
The fact that an investment-grade name like Oracle is trading above 120 is shocking because it implies a very material probability of default, even if it's small, for a company that should be rock solid.
So the market is pricing Oracle closer to low-end junk debt than high-end investment grade.
That's what the signal is saying, yes.
And this movement in the CDS must be mirrored in the physical bond market, right? How do we connect the widening insurance spread to bond prices and yields?
They're two sides of the same coin. When the perceived credit risk goes up, which is what the widening CDS spread tells us, investors who hold that bond, they demand a higher return or yield to compensate them for that added risk.
And bond prices move inversely to yield.
Exactly. So the bond price has to fall. When Oracle's stock dropped sharply after its September high, you saw the bond prices fall, yields surged, and the CDS widened. They're all reinforcing the same stress signal.
So rising yields, falling bond prices, and surging insurance costs. It paints a very clear picture of fundamental credit stress. And it's all being driven by the sheer size of this AI build-out tab.
That's the fundamental story.
Let's focus on that for a minute, this investment-to-profit gap that's creating the worry. We're in a phase where the market requires this massive capital deployment before the revenue shows up.
And that is structurally risky, regardless of how successful AI ends up being.
Right.
It creates immense investor angst. The market is looking at the tens of billions of dollars already committed to infrastructure, and they're comparing that to the expected but not yet realized profits that might take years to arrive. We are firmly in the spend now, profit later, maybe phase.
And strategists are calling this the building phase. And it seems like a multi-year, highly capital-intensive commitment.
That is the exact framing. This whole AI trade, it's not a quick 2-year bet. It's widely viewed as a long-term, maybe 10-year structural shift.
Okay.
So right now, the industry is in an intensive capital expenditure cycle. This means, spending a lot of money without a lot of revenues coming in.
You're not just buying chips.
No. You're laying fiber, you're securing enormous amounts of electricity, building these immense data centers, and you're paying all the operating costs before the first profitable AI contract really scales up. This requires patient capital.
And the debt market is inherently impatient.
Simply impatient.
And the near-term reality for Oracle's free cash flow, it must directly reflect this huge upfront investment.
It's the key financial vulnerability. Oracle's free cash flow is projected to be massively negative for the next few years. That is a siren call for credit investors.
Because negative cash flow means you can't fund your operations internally.
Right. Let alone your build-out.
Yeah.
You are forced to go back to the capital markets to issue even more debt just to cover that spending gap. And that self-reinforcing cycle of debt issuance, it just amplifies the credit risk, especially with interest rates where they are.
This structure sounds fundamentally familiar to anyone who remembers previous tech manias. Are we really seeing echoes of the dot-com era here?
The historical analogies are being drawn constantly by market strategists. I saw one from TD Securities who explicitly warned that this AI boom echoes previous periods of market mania that drove asset valuations to extremes.
Right. Back then it was eyeballs instead of profits.
Exactly. During the dot-com bubble, companies were valued based on eyeballs or potential market share rather than actual earnings or cash flow. Today, the enthusiasm is based on future AI training hours or hypothetical revenue from next-gen models. The market is pricing in absolute guaranteed success years in advance.
And the risk is that the timing or the scale of those revenues might be overheated.
That's the core thesis of the credit skeptics. And the contrast with Oracle's peers just starkly highlights this vulnerability.
You mean Microsoft and Google again?
Look at them. Microsoft's market cap is over $4 trillion. And critically, they fund their expansions via their decades-old, robust, highly profitable cloud operations. Azure and GCP generate massive, reliable cash flows. They can absorb a prolonged building phase.
But Oracle doesn't have that deep established cloud cash cushion.
Precisely. Oracle relies almost entirely on new bond issuances, that $18 billion in public debt, the proposed $38 billion in private credit. This means their debt-to-EBITDA ratios are skyrocketing at a time of high interest rates. They are amplifying default fears in a way their peers simply are not.
So it's new, expensive debt versus existing internal cash flow. That's the gap.
That's the fundamental credit gap.
And the equity market already reacted to this, didn't it?
The stock provided the first warning shot. After Oracle rallied an astonishing 191% earlier this year, just on the AI promise, the stock has corrected dramatically. Since its peak in September, the stock is down a sharp 46% in 3 months.
46%.
That rapid sell-off is equity investors signaling they are intensely nervous about the execution risk and the sheer cost. A big, persistent sell-off in the stock acts as a primary warning that credit investors are also getting twitchy.
The two markets are very tightly correlated here.
Extremely.
So the fundamental risk is clear. Massive debt, negative cash flow, and a valuation that relies on future perfection. But this only explains a fraction of the CDS spike.
Right.
We need to pivot now to the technical market forces that took that, say, 40 basis point risk and amplified it to 128.
This is the really interesting part.
Okay, here's where it gets really interesting and where the sources shed light on the complexity beneath the surface. We've established the fundamentals are weak.
They're stressed.
But even weak fundamentals shouldn't push an investment-grade company to crisis-era CDS levels unless something else is happening.
And something else is absolutely happening. This is the critical, often hidden driver. The technical dynamics are exerting immense upward pressure on Oracle's CDS spread, largely independent of Oracle's actual day-to-day operations.
Okay.
As we mentioned, CDSs for investment-grade names like Oracle, they historically haven't traded much. People didn't need to hedge minimal default risk. Now they do, but the reason for hedging is often focused on that wider data center ecosystem, not just Oracle itself.
So let's introduce this concept of proxy hedging. Can you give us an analogy to help us grasp it?
Okay, think of it this way. Imagine you own a very expensive, custom-built speedboat. You want to insure it, but no traditional insurance company offers a specific policy for it because it's a unique, illiquid asset.
Right, there's no standard market for it.
Exactly. But the insurance company does offer a cheap mass market policy for a large, standard commercial ferry. If your speedboat sinks, the insurance company selling the ferry policy might agree to pay out, simply because it's the only liquid, standardized policy available that relates to maritime risk in that area.
So Oracle is the liquid, standardized ferry policy. And it's being used to insure a whole fleet of illiquid, high-risk speedboats, the smaller, unrated data center builders.
Precisely. We have to look at the non-Oracle risk transfer that is happening systemically. The core problem is that large banks and institutional lenders have tremendous exposure to this data center build-out, and crucially, a significant and growing portion of this lending is going to non-investment grade builders.
We're talking about private companies like CoreWeave.
Companies like that, yes, they need billions to construct infrastructure, but they're relatively new or they lack the decades of cash flow history that Oracle has.
And these companies are funded through that mushrooming private debt market, which is inherently opaque.
It's opaque and illiquid. Private credit lacks the transparency of public bonds. So these smaller, riskier AI infrastructure companies, they often don't have an actively trading CDS market. Or if a contract exists, it's so thinly traded you can't quickly buy billions of dollars worth of protection.
So if a large bank has say a $5 billion loan out to one of these non-investment grade builders, and they want to hedge that risk off their balance sheet, they can't.
They can't do it directly.
So what's the procedure?
The procedure is proxy hedging. To properly hedge these massive, unrated, or thinly traded exposures, banks look for liquid investment-grade credits that are structurally correlated to the risk.
And in this sector, Oracle is the logical choice.
It's the logical choice. It's a major player, its credit is relatively weak compared to Microsoft or Amazon, and most importantly, its CDS contract is liquid and standardized.
So the banks are buying protection on Oracle because, even with the recent spike, 128 basis points is still an incredibly cheap price to insure a high-yield, non-investment grade risk.
It's phenomenal value for the bank. If you're exposed to a data center company that might have a 5% chance of default, paying 1.28% annually to mitigate that exposure via a liquid Oracle contract is a brilliant technical solution to a difficult hedging problem.
But doesn't this artificially inflate the perceived risk of Oracle itself? I mean, if Oracle's 128 basis points is actually a composite of Oracle's real risk plus the transferred risk of dozens of these illiquid players, then the signal becomes distorted. Isn't that a dangerous flaw in the market's risk gauge?
That is the crux of the systemic concern. The signal is absolutely distorted.
Okay.
The Oracle CDS, which should reflect the credit health of one specific blue-chip company, is now acting as a financial shock absorber for the entire illiquid private AI infrastructure debt market.
And this is why we saw Meta's CDS widen too.
This is why Meta, despite having pristine credit, saw its CDS spread widen after they announced their massive private data center deals. Banks needed a way to hedge, and they used liquid proxies, luckily including Oracle. The result is this artificial pressure on the liquid names, magnifying their spreads far beyond what their own balance sheets would suggest.
So if Oracle's spread is artificially inflated, does that mean the underlying high-yield private debt market is actually far riskier than the proxy signal implies?
That is the essential fear.
Because if the true cost to insure that CoreWeave debt should be, say, 700 basis points, and banks are only paying 128 for a proxy hedge, they're significantly underhedged.
They are underhedged relative to the true fundamental risk, yes, but they are fully hedged relative to what the liquid market allows them to purchase. This creates a hidden vulnerability.
So if one of those non-investment grade builders fails,
the pressure on Oracle's CDS, the proxy, will explode even higher because everyone in that private debt ecosystem will scramble for the same limited liquid protection all at the same time.
You add market psychology to this highly technical picture, and you get a momentum trade.
You get the scramble,
which turns an analytical widening into a full-blown panic spike.
It's intensified by human behavior. Hedge funds see the headline. Oracle CDS hits GFC highs. They don't immediately spend 3 weeks analyzing private credit syndication.
No, the strategy is buy now, ask questions later.
The prevailing rapid-fire strategy is, I see fear, I buy protection now, and I'll figure out why later. And this creates a massive short-term buying effort driven purely by momentum.
This momentum buying then runs straight into a supply issue, which is what forces the price up so fast.
A significant supply issue. There is a critical lack of natural sellers of protection. I mean, why would you want to sell protection on Oracle to take on that default risk at, say, 60 or 70 basis points when the news is full of warnings and technical demand is flooding the market?
The upside is tiny compared to the perceived risk.
It's severely limited, so sellers retreat, liquidity dries up, and the price of the CDS is forced violently wider just to attract new sellers into the market.
So the result is this highly complex and unstable dynamic. We have fundamental debt issuance fear combined with immense technical demand from banks hedging non-Oracle assets, all amplified by a powerful momentum trade.
And it's all happening while the credit spreads for the rest of the big tech sector are near all-time tight levels. Oracle is uniquely positioned as the focal point of the market's stress about the entire AI debt tab.
Which brings us to today. We need to distinguish between a localized spike and a systemic collapse. Is the market truly signaling a new GFC, or is this primarily an Oracle-specific issue amplified by all this proxy hedging?
For now, it remains highly localized and technical. You look at the rest of the investment-grade tech sector, the Mount Rushmore of credit, Microsoft, Apple, Amazon, Alphabet.
Right.
Their credit spreads have barely budged. Their massive cash flows are insulating them completely.
So that confirms that the broader, highest-rated tech universe is not in panic.
Not at all. Oracle is the canary, but it's a canary that has been deliberately exposed to the fumes of the less liquid private credit market.
What about the ultimate fear, then? Oracle sliding to junk status. Given that debt trajectory, $290 billion by 2028, is that a realistic outcome?
The rating agencies are providing some stability for now, but their outlooks are negative. S&P and Moody's, they acknowledge the increased risk from the debt pile.
But they don't see it going to junk.
Not in the immediate future, no. Analysts still don't believe Oracle will be downgraded to junk. There's a strong market assumption that the rating agencies will give Oracle substantial room and time to prove the AI revenue thesis.
And some analysts are even citing a sort of implicit too-big-to-fail scenario.
That assumption is pervasive in certain circles, yes. Analysts point to the belief in a huge backing in the capital markets and even the potential for U.S. government support if capital were ever needed for such a massive issuer.
Because a disorderly default would be too disruptive.
Immensely disruptive. The sheer volume of public and private debt outstanding, over $100 billion in public debt alone, means a disorderly default or a sudden downgrade would ripple through the entire fixed-income world. The market is betting on a kind of systemic inertia to protect Oracle's investment-grade status.
That reliance on external forces is a huge risk in itself, but it does provide context for why the price hasn't hit 500 basis points yet. Let's look at the other side of this, the stock price. How tightly should listeners monitor the equity market for signals?
They track very, very tightly. A large, sustained stock sell-off is the easiest signal for a non-credit trader to monitor. We saw the stock correct sharply after the September peak.
Okay.
Right now, traders are focused on major psychological barriers. The stock has bounced off a strong technical support zone, but it faces significant resistance around the $213 to $215 level.
And what should the casual financial observer be focused on?
I would say focus on the major psychological levels. A failure to hold the $200 mark or a prolonged dip below the $185 previous support that signals investor confidence is fundamentally breaking down.
The equity market is telling us whether investors believe the AI revenue story will happen fast enough.
Exactly. If the stock continues to correct, it reinforces the credit market's fear, and that will keep the CDS spread elevated.
The technical picture right now is complex.
It is. The stock momentum is strengthening for a potential tactical rally, but the longer-term indicators are still bearish. The bulls need to break through those key resistance levels to start easing the pressure on the credit side. Failure to do so means the credit fears remain amplified.
So we're in a rally within a broader correction, perhaps.
That's how it looks. The pressure only truly lifts when the stock demonstrates real conviction that the AI revenue pipeline is robust. That's what will reassure credit investors that future cash flows can handle the debt.
All right, this is a dense, high-stakes situation. Let's make sure the listener walks away with a clear, actionable checklist drawing on everything we've covered.
The primary takeaway is that Oracle, as the less cash-rich name and the necessary liquid proxy, it's the pivotal early warning system for the whole AI debt complex.
Okay, monitor I, stock price versus bond CDS prices. Watch for a break below major supports like $185 or $200. If the stock plunges, the CDS will soar.
Monitor 2, new debt issuance and syndication success. Track the outcome of that massive, syndicated $38 billion private credit deal. If Oracle struggles to get that deal done, or if they have to pay much higher interest rates, that signals a huge increase in fundamental risk.
Monitor 3, peer spreads. Watch if debt insurance costs start rising for the true cash-rich hyperscalers, Meta, Amazon, Microsoft. If their CDS spreads start widening significantly, that's the signal that these AI debt fears are expanding beyond the Oracle proxy and turning into a systemic sector issue.
And finally, monitor for cash coverage. Pay microscopic attention to Oracle's upcoming earnings reports. Specifically, look at the ratio of AI and cloud profits versus their interest costs. We need to see clear, accelerating cash generation to comfortably cover the interest bill on that gargantuan debt pile.
If those interest coverage ratios slide, the fear gauge will spike again.
Immediately, because the underlying justification for the debt will just vanish.
So what does this all mean for you, the learner? The Oracle CDS spike is not just a scary headline. It is a highly technical, fascinating collision of massive corporate AI ambitions, extremely aggressive financing, and complex financial engineering that relies on liquid assets to proxy hedge the risk of an exploding, illiquid private debt market.
It's Wall Street's most detailed analysis of the Great AI Build-Out tab, and now you're privy to the mechanics.
This deep dive has really shown you that a jump in a financial derivative is a detailed story about where capital is flowing, and maybe more importantly, where risk is being hidden and transferred.
And this raises an important and, I think, a provocative question that extends far beyond Oracle's immediate future. We discussed the market consensus that Oracle may be implicitly too large to fail, that there might even be government interest in preventing a catastrophic default. If the financial system is relying on that assumption to keep the liquid proxy credit stable, how much risk are private investors and banks truly taking on with all that massive, unrated, non-investment grade data center debt? If the perceived insurance, the CDS on proxy names like Oracle, is artificially inflated by technical hedging, does this not obscure the true danger lurking in the tens of billions of dollars tied up in illiquid private credit?
And if that insurance price is distorted?
Is the market fully prepared for the failure of a major non-investment grade AI builder, knowing that the cost of their hedge is based on a systemic assumption rather than a pure, accurate, fundamental risk assessment? That is the deeper structural problem that the financial engineers need to solve, or risk repeating the mistakes of 2008 in a new AI-fueled bubble.